All right, today we're going to unravel something that might seem a little strange at first. How a handful of people in a boardroom in Washington, D.C. can make crypto prices go absolutely nuts all over the world. Let's get into it. You've seen this happen, right? It just feels so disconnected. Some official in a suit starts talking about jobs and inflation, and the next thing you know, Bitcoin's price is swinging by thousands of dollars. How is that even possible? Well, that's the mystery we're going to solve today. To figure this out, we need to zoom out, way out. Forget about the 15-minute charts for a second and just think about the entire global financial system. You see, the crypto market, as huge as it feels to us, is really just one small part of something much, much bigger. That bigger thing is called global liquidity. And honestly, the best way to picture it is as a giant ocean of money, just a massive sea of cash constantly flowing around the globe, looking for a place to go. Stocks, bonds, real estate, and yep, crypto. They're all just different boats floating on this same ocean. And you know what they say? A rising tide lifts all boats. Okay, so if we have this massive ocean of money, the next question is pretty obvious. Who controls the water level? Well, there are a lot of factors, but the one group with their hands on the main spigot, the institution basically running the dam, is the U.S. Federal Reserve. The Federal Reserve, or as pretty much everyone calls them, the Fed, is the central bank for the United States. And their whole job is to manage the country's money, mostly by setting interest rates. So think about it. By making money cheaper to borrow, they're opening the floodgates to that ocean of money. And when they make it more expensive, they're starting to drain the water out. And this is where things get really tricky for the Fed. They're constantly juggling two main goals, and a lot of the time, these goals are pulling in completely opposite directions. On one hand, they want everyone to have a job, right? Maximum employment. That usually means the economy needs to be running hot. But on the other hand, they have to keep prices from going crazy. That's stable prices, which means fighting inflation. And to do that, you usually have to cool the economy down. So yeah, every single decision they make is this incredible balancing act. So how do they make these massive decisions? Well, they're not just guessing. They have this whole dashboard of economic data that they are watching like a hawk. Kind of like a pilot in a cockpit, staring at all the gauges. And if you can learn to read a few of those same gauges, you'll have a much better idea of what they might do next and what that means for crypto. And as you can see here, the Fed is totally obsessed with the jobs market. They're looking at things like ADP payrolls, which tracks private sector hiring, and jobless claims to see if people are getting laid off. But the big one, the number the entire financial world holds its breath for, is non-farm payrolls. A super strong number tells the Fed, whoa, the economy's hot, maybe too hot. We might need to keep interest rates high to fight inflation. But a weak number? That signals the economy is cooling down, which could push the Fed to lower rates and give it a boost. Okay, so we've got the ocean of money, and we've got the Fed at the controls watching its dashboard. Now for the most important part. Let's connect the dots. How exactly does a ripple from a decision in Washington, D.C. travel all the way to your crypto portfolio? It really starts with this one number, 0.55. That's a measure of how closely Bitcoin has been tracking the U.S. stock market. What it means is that, lately, more than half the time, they move in the same direction. The days of crypto existing in its own little bubble, totally separate from everything else, well, those days are over. It's now another boat in that big ocean of money. And this quote right here just nails the reason why. Think about it from an investor's point of view. When the Fed raises interest rates, you can suddenly earn a safe, guaranteed return just by putting your money in government bonds. So why would you take a huge risk on a volatile asset like Bitcoin that pays you nothing just for holding it? That choice you have to make is called opportunity cost. The better the safe alternatives look, the less attractive the risky ones become. This chart shows that dynamic perfectly. When interest rates are high, the opportunity cost of holding crypto is also really high, so capital flows out and into safer stuff. But when the Fed lowers rates and those safe assets are barely paying you anything, investors get hungry for returns. They start taking on more risk, and all that capital comes flooding back into assets like crypto, pushing prices up. It's a classic inverse relationship. So now we get the why. But the real question is, how do we use this knowledge? And look, this is not about trying to predict the future or making some degen gamble. No way. This is about building a smart framework for navigating the news and, most importantly, managing your risk. And speaking of smart frameworks, check this out. This data shows a really fascinating pattern. If you look at the last 8 big Fed meetings, after 7 of them, Bitcoin's price actually dropped in the 48 hours that followed. And get this, it even happened when the Fed cut rates, which you'd think would be great news for crypto. It's a classic sell the news event. By the time the announcement happens, the market has already priced it in, and the event itself just becomes a trigger to take profits. So all of this leads to a pretty clear playbook. First, analyze the language. Don't just predict the decision. The market almost always knows the rate decision in advance. It's the Fed chair's hints about the future that really move things. Second, reduce your leverage. The historical pattern clearly favors downside risk, so high leverage is just a liability. Third, wait for the dust to settle. That first move right after the announcement is almost always a fake out. And fourth, be patient. Patience is your edge. The real informed trade happens hours or even a day later, not 2 minutes after the press conference starts. And this leaves us with the big question for the future. Right now, crypto is clearly caught in the Fed's gravitational pull. But as more and more institutional money comes in and real regulation takes shape, will crypto finally become big enough to have its own center of gravity? Or will it always be a boat tossed around on the Fed's ocean? That's the story we're all here to watch unfold.